Hi, in this blog post I talk about bear market survival guide. Hi, I'm Chris Reddick, a financial planner. And what if I told you that two investors could start retirement with the exact same amount of money and face the exact same bear market, but one runs out of money while the other stays financially secure for 30 years? The difference isn't luck, it's asset allocation. Let's dive in. Here's the brutal math of bear markets. If your portfolio drops 20%, which is a classic bear market, you need a 25% gain just to break even. If it drops 30%, you need 43% to recover. And if you're unlucky enough to retire right before a major market crash, well, that's when sequence of return risk can destroy decades of careful saving. But here's what most people don't realize. Your asset allocation, how you split between stocks, bonds, and cash, determines not just how far you fall, but how fast you recover. Let me show you 4 proven allocation strategies using simple, low-cost index funds. First, the aggressive growth portfolio. This is where you have 80% stocks and 20% bonds and cash. In a major bear market, that might drop 25 to 30%. And historically takes 3 to 6 years to fully recover. This works if you're young and can handle the roller coaster. A second is growth with ballast. 70% stocks, 30% bonds, and cash. Typically sees a 20 to 25% drop and recovers in 2 to 4 years. Still growth focused, but more manageable swings. In this model, third, the classic balance. This is a 60-40 stocks bond portfolio. This is a sweet spot for many near retirement or in retirement. Historical drops stay in the mid-teens to low 20s range, and recovery is 2 to 3 years. Research shows this allocation has worked consistently across 115 years of market history. The balanced approach, 60-40. Finally, the defensive balanced is 40% stocks, 60% bonds, and cash, designed for current retirees or those with a lower risk tolerance. Drops are often single digit to low teens, recovering 1 to 3 years. But here's a critical piece most people miss. Cash reserves. If you're retiring or near retirement, you should have 2 years of living expenses in cash. Why? Because selling stocks when they're down 30% locks in losses forever. So these are called sequence of return risks. And don't forget to rebalance. When stocks crash, your bond and cash allocations become buying ammunition. Rebalancing focuses you to buy low and actually speed your recovery. Remember, bear markets are temporary, but selling at the wrong time can create permanent damage to your wealth and impact your retirement. Which allocation matches your situation? The aggressive growth portfolio, if you have decades from retirement, the balanced portfolio, if you want a steady progress, or the defensive strategy, if you're protecting wealth in retirement. Drop a comment below with your target allocation, and hope this blog post was helpful to help you prepare for bear markets. Hope you have a great day. Thank you.